If you put your money into a passive dividend ETF, you expect it to be, well, passive.
Right, exactly.
Yeah.
Just a sleepy, set-and-forget-it portfolio.
Yeah, you essentially look away for a decade and trust the broader market current to just sort of carry you along. But last night, the Schwab U.S. Dividend Equity ETF,
Widely known by its ticker SCHD, of course.
right, SCHD, it quietly swapped out nearly a third of its entire $100 billion portfolio while the market was closed.
Which is just a massive institutional pivot.
Right.
I mean, we're looking at 25 companies brought into the fold and 22 completely removed.
Billions of dollars in reallocated capital.
Billions, yeah.
And that level of turnover totally shatters the illusion of passive investing being uneventful. So, welcome to the deep dive. Today we're poring over a stack of fresh sources, including financial reports, ETF analysis from top dividend ETFs, and stock analysis, alongside Charles Schwab's official fund data.
Lots of data to get through.
Tons of it. We are tracking the massive March 2026 reconstitution of SCHD to figure out, exactly why this shakeup happened, why megacaps like UnitedHealth and Qualcomm suddenly made the cut, and what this portfolio shift means for your long-term dividend growth. So, okay, let's unpack this.
Right, so to understand a shift of this magnitude, we really have to look at the mechanics governing the fund first. Because SCHD is not, it's not actively managed by a team of analysts sitting around debating market sentiment.
There's no guy in a suit making a gut call.
Exactly. It strictly tracks the Dow Jones U.S. Dividend 100 Index. And that index operates on a purely rules-based algorithm, right? Starting with a totally non-negotiable barrier to entry.
Which is the 10-year rule, right?
Yes. A company must have paid a consecutive, uninterrupted dividend for at least 10 years.
Which, I mean, a decade of flawless payments just to get a seat at the table is wild. That immediately filters out those companies that slash their dividends during, brief macroeconomic panics.
Oh, absolutely. But passing that 10-year mark is just the preliminary check. It's just the bouncer at the door. The real filtration happens through a composite score based on 4 equally weighted metrics.
Okay, what are the 4?
So the algorithm looks at free cash flow to total debt, return on equity, the indicated dividend yield, and finally the 5-year dividend growth rate.
Those 4 metrics are doing some serious heavy lifting here.
Oh, yeah.
Because by demanding high free cash flow relative to total debt, the algorithm isn't just looking for a large pile of cash. It's demanding proof that a company can actually service its debt obligations without, having to cut your dividend check to do it.
Exactly. It's a structural health check.
Yeah.
And then return on equity shows that management isn't just sitting on that capital. They're actively generating profit from shareholder equity.
Right.
So you combine those health checks with the yield and the 5-year growth rate, and you get a very clear picture of both current income and future income potential. But the competition for the top 100 spots is just ruthless.
How ruthless are we talking?
Well, for this 2026 reconstitution, the cutoff dividend yield to even be considered was 2.07%.
Wow. So anything below 2.07 is just out.
Automatically discarded. Doesn't matter how good the company is.
It kind of functions like a purely analytical sports team general manager, like
Right.
the kind who will trade away a beloved franchise player based entirely on declining stats without an ounce of sentimentality.
That is a perfect analogy, actually.
But if it's purely mechanical, does that mean the ETF is basically forcing a buy low, sell high strategy without human emotion?
It absolutely does. The sources explicitly point this out. Because the 22 stocks that were removed from SCHD this year, they had actually surged in price by an average of 26.79% over the past 12 months.
Over 26%. Okay.
Yeah. Meanwhile, the 25 newly added stocks had dropped in price by an average of 23.43%.
That is wild. The algorithm is literally systematically executing the holy grail of investing, selling high and buying low.
Completely bypassing human emotion. Because, when a stock price surges 26%, human psychology tempts us to hold on forever. We want to chase that momentum.
Oh, for sure. FOMO kicks in.
Right. And when a stock drops 23%, our instinct is to panic sell. But by adhering strictly to the yield metrics, the index trims exposure to overvalued assets and redirects that capital right into fundamentally sound companies that are trading at a massive discount.
So if the algorithm is ruthlessly scanning the market for these discounted stocks generating massive cash flow, where exactly did it find them in 2026? Because looking at the additions, it seems to have zeroed in super aggressively on healthcare.
It did. Healthcare is the big winner here.
Yeah, like UnitedHealth, ticker UNH. It's now a massive anchor for this fund. Healthcare has swollen to over 21% of the entire portfolio.
Driven heavily by UNH and Abbott Laboratories as well.
Right. So why UNH?
UnitedHealth provides a perfect case study for the index's mechanics. Over the trailing year, UNH's stock price plummeted roughly 48% from its all-time highs.
Yeah. 48%. Half its value.
Almost half, yeah. And dividend yield is a really simple calculation, right? You just divide the annual dividend payout by the current stock price.
Right.
So when the denominator, the stock price shrinks by half, the yield mathematically spikes.
So the company is paying out the exact same amount of cash, but the cost to buy a share is suddenly on clearance, making the percentage yield much more attractive.
Exactly. UNH's yield spiked to roughly 3.2%. So the algorithm detected that elevated yield, cross-referenced it against UNH's free cash flow and return on equity, and basically determined, hey, this company is highly undervalued relative to its core business strength.
Wow.
So it was immediately slotted in as a top 10 holding. It absorbed about 4.2% of the entire ETF.
But here's where it gets really interesting, though, because if a company's stock drops 48%, financial media is usually like writing its obituary.
Oh, they were panicking.
Right. Buying into a 50% drawdown is traditionally viewed as catching a falling knife. So if the market is valuing UNH that poorly, how does a dividend investor know they aren't just buying into a dying business?
And that distinction right there between a structural failure and just a temporary market dislocation, that is precisely why the free cash flow and return on equity screens exist.
Because it proves they still have cash.
Exactly. If a business drops 48% because its core operations are actively bleeding capital, its free cash flow debt ratio will immediately trigger an alarm, and the index will reject it as a value trap.
Got it. So it filters out the companies that look cheap but are actually just going bankrupt?
Yes. UnitedHealth is fundamentally sound. The 48% drawdown was driven by broader sector rotations and regulatory pressures regarding Medicare Advantage reimbursement rates.
Government regulations.
Yeah, institutional investors often just flee when government regulations threaten short-term margins. It creates a massive price drop. But the underlying demographic trends, like an aging population requiring health care, those remain completely intact.
The demand isn't going anywhere.
No, not at all. So the algorithm confirmed the cash flow was resilient despite the regulatory noise. And that allowed the fund to lock in a premium yield on a dominant market leader.
It is essentially buying a blue chip asset during a temporary PR crisis.
That's a great way to put it.
And that brings us to the other major heavyweight added to the roster, which is Qualcomm, ticker QCOM. It came in alongside Accenture and ADP, pushing the fund's information technology exposure up to 8.76%.
Which is a big jump.
It is. And seeing a semiconductor company in a strict dividend fund always feels a bit, I don't know, unusual.
It's incredibly rare. Finding any legacy technology company that survives the Dow Jones U.S. Dividend 100 screening is tough.
Why is that? Just because they don't pay dividends?
Well, the technology sector is inherently capital intensive. Companies typically reinvest the vast majority of their free cash flow right back into R&D just to stay competitive, rather than returning that cash to shareholders.
Which is why you don't see the massive tech darlings like Apple or Nvidia dominating this specific ETF.
Right. Their stock prices are astronomically high, and their focus is heavily on growth, so their actual dividend yields are just a fraction of a percent.
Nowhere near that 2.07% bouncer at the door we talked about.
Not even close. But Qualcomm navigates a very specific niche. They have the standard semiconductor cyclicality, sure, but they also possess a massive portfolio of patents.
Oh, so they just collect fees.
Exactly. That licensing revenue provides a highly predictable, recurring stream of cash flow that many pure-play chip foundries just don't have. So they cleared the 10-year consecutive payment hurdle, they offer a competitive starting yield, and they boast a very aggressive 5-year dividend growth rate.
So integrating a tech giant with robust cash flow like Qualcomm just diversifies the portfolio. It adds this potent engine for capital appreciation alongside the traditional slower-moving consumer staples.
Precisely.
But to fund a multi-billion-dollar shopping spree for UnitedHealth and Qualcomm, the index had to liquidate a massive amount of capital elsewhere.
Had to make room.
Right. 22 stocks were shown the door, and the biggest loser by sector was energy, which saw its portfolio weight slash by 7.62%. It dropped down to roughly 14.3%.
A huge cut.
We're talking about major players like Valero Energy, ticker VLO, and Halliburton, ticker HAL, getting completely removed.
Now, the energy sector perfectly illustrates the inverse of the UnitedHealth scenario. We just discussed how a plummeting stock price artificially inflates the dividend yield. Well, in the energy sector, we saw the exact opposite.
Right, because oil was surging.
Yes. Global oil and energy prices experienced a massive surge, driven largely by geopolitical instability. The sources highlight the ongoing supply chain disruptions following the Iran conflict, for example.
So as the price of crude oil spiked, the stock prices of Valero and Halliburton skyrocketed right along with it. And because their stock prices went up so rapidly, their dividend yields were mathematically diluted.
Exactly. The denominator got too big.
Hmm.
So the yield for many of these energy stocks fell well below the fund's internal threshold, which was averaging around 3.5% for its admitted holdings.
So the algorithm recognized that the stock prices were being artificially inflated by a temporary geopolitical commodity shock, not necessarily like long-term structural growth.
Right. And by liquidating those positions, the fund effectively locked in the massive gains from the energy rally before the commodity cycle inevitably turns,
It just took the profits off the table.
very mechanically.
But the casualties weren't limited to just the energy sector. There were a few surprising tech and healthcare names that got removed as well. Specifically Cisco, ticker CSCO, and AbbVie, ticker ABBV.
Yes, those were big surprises to a lot of people.
I was looking at the valuation metrics, and Cisco's removal actually makes total sense when you look at the multiples. Cisco's price to earnings, or PE ratio, had ballooned to 28.2.
Huge.
Meanwhile, the average PE for the stocks that actually survived the screening process was sitting around 11.
Right.
So Cisco was essentially being priced like a hyper-growth AI startup rather than a mature, steady dividend payer.
And what's fascinating here is how often investors misinterpret these algorithmic purges. A company being dropped from the index is not an indictment of its underlying business model.
So if I hold Cisco or AbbVie in my personal portfolio, does this mean they're suddenly bad companies?
Not at all.
Yeah.
AbbVie and Cisco remain highly profitable enterprises generating massive revenue.
But the index is a zero-sum game. There are only 100 spots.
And at this specific moment in time, Cisco and AbbVie simply lost the relative mathematical battle. Their valuations became too expensive, and their yield shrank too much compared to the deeply discounted opportunities available in companies like UnitedHealth and Qualcomm.
So they weren't necessarily performing poorly. They just got outcompeted on a relative composite basis.
Exactly. They were just too expensive for what they offered.
So what does this all mean? For you, the investor holding this ETF, or honestly anyone trying to construct a resilient dividend portfolio, we've analyzed the trades. The algorithm sold off the geopolitical energy spikes and the overpriced tech, and it bought the temporarily distressed healthcare and legacy chipmakers. When the dust settles on this 2026 reconstitution, what does the underlying foundation of this portfolio actually look like?
Well, the fundamental architecture of the fund experienced a massive upgrade. Let's examine the valuation first, because the fund systematically purged expensive stocks like Cisco and absorbed discounted stocks like UnitedHealth. The overall price-to-earnings ratio of the entire portfolio compressed from 19.31 down to a highly attractive 18.18.
That's a noticeable drop, meaning you are paying significantly less capital for every dollar of earnings these 100 companies generate. It's just a cheaper, more efficient portfolio.
Much more efficient. But we also have to look at the earnings trajectory. The 3-year earnings per share, or EPS growth rate, saw a notable shift. Prior to the rebalance, the portfolio's EPS growth rate was sitting at negative 7.33%.
Okay.
After the rebalance, that improved to negative 2.54%.
Wait, time out. You just said that EPS growth is still negative 2.54%.
Yes.
Why would I want to invest my capital in a portfolio where the underlying corporate earnings are actively shrinking?
I know it sounds bad, but that requires critical macroeconomic context. Corporate earnings across the entire S&P 500 have been undergoing a severe normalization process.
Oh, right, because of the pandemic stimulus.
Exactly. During the pandemic recovery, companies experienced artificially inflated earnings due to massive fiscal stimulus and zero interest rate policies. What we are seeing now is the hangover from that. Higher borrowing costs, sticky inflation, and compressed profit margins are dragging down earnings across the board.
So a negative earnings growth rate isn't necessarily a failure of the fund. It's just a reflection of the current economic reality for mature dividend-paying companies right now.
Yes. An improvement from a negative 7% drag to a negative 2.5% drag is a massive relative victory. The portfolio is stabilizing its earnings floor much faster than the broader market.
Okay, that makes sense.
But the most vital metric for long-term compounding, by far, is the dividend growth rate.
And this is where the 2026 reconstitution really proves its value. Right.
Absolutely.
The 5-year dividend growth rate for the entire portfolio jumped from 8.85% to a very robust 9.28%.
Which is huge.
We are talking about nearly double-digit annual growth in the actual cash being paid out to shareholders.
And achieving a 9.28% future dividend growth rate is impressive on its own. Achieving it while maintaining a current dividend yield of roughly 3.4 to 3.6% is, well, it's extraordinary.
Because normally you have to compromise.
Historically, yes. Investors are forced to choose. You either accept a high starting yield with stagnant growth, or you buy into high dividend growth with a starting yield of like 1%.
Right.
This algorithmic rebalance successfully threaded the needle. It secured significant future growth without sacrificing immediate income.
The methodology also fundamentally alters the risk profile, doesn't it?
Right.
By stripping out the highly volatile energy sector, which lives and dies by global oil supply, and replacing it with highly resilient consumer staples and healthcare, the algorithm is essentially acting like a financial thermostat.
That's a great visual.
It automatically cooled down the overheated sectors and warmed up the frozen, undervalued ones to just maintain this steady defensive environment.
And the historical data totally validates that defensive posture. Over the last decade, SCHD's worst 12-month return was only a negative 10.88%.
Wow, that's incredibly low for a worst-case year.
In the context of equity markets, that level of downside protection is rare. This recent turnover just reinforces that defensive moat. It ensures the portfolio is anchored by companies that generate cash, regardless of the economic weather.
Let's bring all these threads together for you. The March 2026 reconstitution of SCHD wasn't just routine maintenance. It was a nearly 30% overhaul of a $100 billion machine.
A massive, massive shift.
Yeah. And by strictly following its 4-part composite screening, the index dumped overvalued assets like Cisco and geopolitically inflated energy stocks. It redirected that capital into fundamentally dominant companies like UnitedHealth and Qualcomm that were just suffering temporary market panics.
It bought the dip on premium assets.
Exactly. And the end result? A cheaper overall portfolio valuation, an improved earnings trajectory, and a 5-year dividend growth rate pushed above 9%, all while maintaining a solid mid-3% yield.
We have spent this entire session analyzing how a passive, mindless algorithm flawlessly executed the most difficult maneuver in finance. It overcame human emotion to buy low and sell high.
Yeah.
It upgraded the portfolio's quality without a single board meeting or debate, which leaves us with a really compelling question to consider for our own financial lives. In an era defined by 247 financial doom-scrolling, information overload, and panic trading, is the ultimate secret to long-term wealth simply tying ourselves to a rigid system that prevents us from outsmarting ourselves.
When the math is that effective, maybe the best action a human investor can take is simply getting out of the algorithm's way. Thank you for joining us on this deep dive. Keep questioning the mechanics behind your money, trust the data over the headlines, and we will catch you on the next one.